Hey, what's going on, everyone? Sean from PlanningFire.com. Welcome back to my book review series on the only investment guide you'll ever need. Welcome to part 4, the stock market. Now, before I dive too far into it, if you like this content, hit that subscribe button or hit the bell to get notified as soon as I release videos. If you want to read this with me, check the link below. I'll provide it, that way you can read it with me, and I'd love to have that conversation. So welcome to part 4, the stock market. Now, if you're considering investing in the stock market, congratulations if you've made it this far in your journey. That means your 401k is maxed, your Roth IRA is maxed, your budget is well set and locked in, knowing that you're spending only what you need to spend. You have all of your high interest debt paid off, and you have a little extra money at the end of each month to put into the stock market. Also, at this point, if you're following along with this book as well, you may have already bought cases of wine and you're sitting on rolls of toilet paper until the end of times to save on that bulk discount, and maybe that's where this cash came from. So why would you want to use stocks? Well, other traditional and safer investment vehicles like bonds tend to give you much less of a return for the same amount of money. And on average, over the long period of time, bonds don't beat inflation. So essentially, by having your money tied up in bonds, you may be safe and you may be getting some return, but in reality, you're losing money because bonds are returning less than inflation, meaning your cash is sitting there, inflation is growing, but bonds are growing at a slower rate than inflation. Also, another great reason to use stocks is because they're considered a tax shelter. So if you purchase something at, say, $20 a share and it goes up to $50, you don't have to pay taxes on that gain until you sell them. And if you wait a year and a day to sell them, you only have to pay capital gains tax. That's 15% as opposed to whatever your income tax may be, which could be anywhere from, say, 20 to 40%. The other nice part about stocks is there's really only two outcomes. You're either going to win or you're going to lose. So it makes investing very easy to find out. It's not like you're sitting there wondering if you're going to win or lose based on different factors. You can easily see the charts and graphs going up and down. That said, I highly recommend you don't watch them because that is a great way to put yourself in the insane asylum. Now, that said, unless you know something that I don't about stocks, and if you do, it's probably considered insider trading, so tread lightly. But if you know something I don't, you should probably be just investing in very low fee index funds. Essentially, an index fund aggregates a series of stocks that you couldn't afford to purchase on your own, but it gives you a small piece of a lot of different stocks. This allows you to really diversify your investment and makes for a much easier and much lower risk investment opportunity. That said, you're going to want to make sure you have a no load, meaning no fee, or very low fee index fund. So that way you're not just getting beaten up by these administrative overhead fees. So in the only investment guide you'll ever need, he lays out 10 rules for investing in the stock market. And I'm going to go through those here. 1, only invest money you won't need for many years. That's obvious. If you can't afford to lose the money, don't put it in stocks because at the end of the day, it is going to be a gamble. 2, buy low and sell high. Now, if there was a surefire way to do this, we'd all be millionaires, but in this case, it's obvious, but it is a great way to win at the stock market. 3, diversify by buying over time, also called cost averaging or something along those lines, dollar cost averaging. Basically, if you buy a couple shares at 20 and a couple shares at 25, and then you lose money and buy a couple shares at 18, but then it goes up to 30, your taxes are different on all of those, and you can leverage advanced tax strategies to make some savings. But buy, diversify over time. 4, stick with it and don't let fear drive your decisions. If the market's bottoming out like it did in 2008, that's a great way to sell low. If you held on to those same stocks, you'd be at a much better place than you were in 2007 now. So don't sell just because of fear. 5, ignore all the noise, buy and hold. See number 4. Essentially, just because someone says there's a great opportunity or you're missing out, don't let that control your stock buying decisions. You're in it for the long haul. These are investments. These are not gambles. So make sure you're only selling when it makes sense. Number 6, beware of the stocks that everyone likes because they're probably already high. Now, that's a tough one. It is true. If you are buying something that everyone likes, like Amazon, for example, that stock is already incredibly high. It's not like you're getting in at the ground level. So if you're trying to make a lot of money on stocks, it's probably best to buy some riskier investments. But again, keep in mind, it's gambling. Number 7, and this is for more advanced people, but price to earnings ratios are not the entire story of a stock. So it's a great way to quickly measure how a company is doing, but it's not necessarily the only truth behind it. Number 8, don't buy based on people's hot tips. If someone comes up to you and says, hey, I've got a great opportunity for a stock, you should buy it. Instead of getting into an argument, put it in your mental bank, keep an eye on that stock, see how it does. If that person comes up to you again and says, hey, I have a hot tip for a stock, and the last one did great, maybe consider it with a little more value this time. But everyone has hot tips, and not everyone's rich, so I'll let you do your own research. Number 9, We're investing here, we're not speculating, we're not day traders. If you have that kind of capital and that kind of time, all the power to you. But what we're talking about and the only investment guide you'll ever need is long-term buy and hold investments. Speculation is an entirely different story, and that's not something that they cover here in this book. And number 10, sell only when you think a stock is no longer a good buy, meaning that the stock has rose so much that you no longer think it's worth it, or perhaps if you are ready to cash out and diversify your investment. Now, this is obviously the best strategy because if you're keeping track of what you own and then you go and sell it, that's a great way to actually realize some of those gains, and congratulations, you've made yourself some money. But make sure it's been over a year so that way you don't have to pay full income tax on it, and also make sure you're doing what's best for your tax situation. That's a whole nother video and a whole nother conversation, but for now, only sell when you think a stock is no longer worth it. Now, this is a big one. The next section references ignore your broker, and that's really important. Essentially, given enough time, brokers average about 1% over your blind investor. So if you're a regular person at home picking stocks they know nothing about, a broker tends to do 1% better than those folks do. That said, they also have a large overhead and a large management fee. So I highly recommend you leverage low-cost, low-fee brokers like a Vanguard, and that way you don't have to pay for some other person's mistake. They also could lose you money, but they're still going to get their cut. So it's very difficult to become profitable when you're leveraging a broker. So I recommend ignoring a broker and doing your own thing. Now, if you reference the article below, assuming you're watching this on planningfire.com, you're going to see a whole list of terminology. I'm not going to cover this all because it would make for very boring video or podcast content, but I'll hit some of the key elements you need to understand in the stock market. The idea of cash. Cash is anything liquid and on hand. It could be in savings accounts, checking accounts, what have you. Cash you can use to buy stocks. Cash you can use to pay for groceries. So it's liquid and available. Stock dividends are basically a fee paid out per share of stock you own. Dividend stocks are a great way to make truly passive income. Your portfolio is your entire collection of stocks, bonds, and similar. That's what you own. Options are an entirely different ballgame. If you hear someone talking about options, you're going to have to do your own research on those for now. They are very complicated, but a great way to leverage a lot of stock you can't actually afford to buy. Tax timing, we kind of touched on this, but we should probably go into more detail on it. Essentially, knowing when to sell stock. If you know you had a big win, you may consider selling some of your stocks you've taken big losses on to try to balance that out. Recognize those losses and make sure you're not going to end up owing a ton of money. But tax timing is what that theory is all about. And really that's it for the individual terminology that I want to highlight. So I don't know if you know this or not, but I've actually started putting the audio versions of these videos down as a podcast on planningfire.com. I highly recommend you check them out. It's a great way to consume this material if you're not going to be in front of your computer. But that's the only investment guide you'll ever need, part 4. This book has been very straightforward. I really like his style. I recommend you check it out with me. The link's in the description below. If you have any questions or comments, I'd love for you to leave those below as well. Hit that subscribe button so you can start to get this content as I release it. Until next time, I'm Sean from Planning Fire, and I hope you have a great winter. Try to stay warm out there and take care.